Welcome back to another episode of Control Cash, your no-nonsense guide to personal finance. Most of the videos on this channel focus on high-income dividend investing, using cash-producing assets to reach financial independence earlier than most. But today, we are flipping the script. I'm breaking down the top 5 dividend growth ETFs on the market. These funds are perfect for investors who want reliable dividends and long-term wealth growth through price appreciation. If you find this video helpful, make sure to hit like and subscribe for more investing breakdowns. First up on the list is SCHD, which is the Schwab US Dividend Equity ETF. SCHD is one of the most popular dividend growth funds available today. It's a passively managed ETF that tracks the Dow Jones US Dividend 100 Index, focusing on large, high-quality US companies with a strong history of paying and growing dividends. SCHD leans heavily into industrials, financials, consumer staples, and healthcare, giving investors broad exposure to stable, blue-chip sectors. The fund currently offers a dividend yield of around 4% with quarterly payouts. What makes SCHD stand out is its long-term performance record. Over the past decade, it has consistently delivered both steady dividend growth and meaningful price appreciation. A $10,000 investment 10 years ago would be worth about $30,000 today, assuming dividends were reinvested. That's an impressive 12% annualized return, nearly matching the S&P 500 while keeping a stronger emphasis on dividends. Even without reinvestment, investors would have enjoyed a reliable stream of cash flow alongside solid capital growth. This combination of compounding income and price gains is why many dividend investors consider SCHD a cornerstone holding. Next on the list is VIG, which is the Vanguard Dividend Appreciation ETF. VIG is another core option for dividend growth investors. It's passively managed and tracks the S&P US Dividend Growers Index, which only includes companies with at least 10 consecutive years of dividend growth. That means you're getting a portfolio of reliable blue-chip companies with proven staying power. VIG tilts towards industrials, financials, technology, and consumer discretionary, giving it a balanced mix of growth and defense. Its yield is on the lower side at about 2%, with quarterly payouts, but the emphasis here is on steady, sustainable increases rather than chasing high yield. Historically, VIG has delivered strong performance. A $10,000 investment 10 years ago would now be worth about $26,000 with dividends reinvested, translating to an annualized return of about 10%. While this trails SCHD slightly in total returns, VIG has been one of the most consistent funds for pure dividend growth. For investors who value stability and quality, VIG is often a top choice. Up next, we have DGRO, which is the iShares Core Dividend Growth ETF. DGRO is a BlackRock's flagship dividend growth fund. It's passively managed, tracking the Morningstar US Dividend Growth Index, which screens for companies with a history of dividend growth while excluding those with unsustainable payout ratios above 75%. This ensures the fund is built on companies that not only pay dividends, but also have room to grow them. DGRO leans into financials, healthcare, technology, and industrials, and currently yields around 2.5%, with quarterly dividend payments. Although DGRO launched in 2014, it has quickly proven itself. Over the past decade, a $10,000 investment would have grown to about $24,000 with dividends reinvested, equating to roughly a 9.5% annualized return. While not the highest yielding option, DGRO is popular for its balance of steady dividend growth, sustainability, and low cost. Up next, we have DGRW, which is the WisdomTree US Quality Dividend Growth ETF. DGRW takes a slightly different approach. It's passively managed, but uses WisdomTree's proprietary methodology, focusing on companies with strong earnings growth potential and solid balance sheets that support future dividend increases. DGRW leans more toward technology, healthcare, consumer discretionary, and industrials, giving it growth tilt compared to SCHD or VIG. Since launching in 2013, DGRW has held its own. A $10,000 investment 10 years ago would now be worth about $25,000 with reinvested dividends, translating to a 9.7% annualized return. Investors looking for a dividend growth ETF that emphasizes forward-looking earnings power often add DGRW as a complement to more traditional picks. Last on the list is VYM, which is the Vanguard High Dividend Yield ETF. VYM is a little different from the others. While it's not purely a dividend growth fund, it focuses on high dividend-paying U.S. companies, making it a hybrid between growth and income. VYM is passively managed, tracking the FTSE High Dividend Yield Index, with heavy exposure to financials, consumer staples, healthcare, and industrials. It currently offers a yield of 3 to 3.2% with quarterly distributions, appealing to those who want more current income. Over the past decade, VYM has performed strongly. A $10,000 investment would have grown to about $27,000 with dividends reinvested, equating to roughly a 10.5% annualized return. While it doesn't deliver the same pure dividend growth story as VIG or DGRO, VYM strikes a nice balance by offering above average yield and steady growth, making it a great middle ground choice. Doing a little bit of comparing here, when you line these funds up, each one brings something unique. SCHD is the gold standard with its higher yield and stellar track record. VIG is the safety first option with unmatched consistency. DGRO balances growth with sustainability, while DGRW focuses on future earnings and forward-looking growth. And VYM offers higher current income without giving up long-term compounding. The best choice really depends on your strategy, whether you want maximum compounding, stability, or more income today. So let me know in the comments, which of these dividend ETFs would you put at the top of your list and why? I'd love to hear your approach. And if this video brought you value, make sure to hit that like button and subscribe for more no-nonsense investing guides here on Control Cash. Until next time, keep investing, keep stacking those dividends, and I'll see you in the next one.